You're live, Catherine.
Well, welcome back, everyone. Bienvenue à tous et à toutes. I'm very pleased now to introduce our next session of the day, a highly anticipated fireside chat with the Governor of the Bank of Canada, Tiff Macklem. To kick off this session, it is my great pleasure to introduce Mairead Lavery, President and CEO of Export Development Canada, for some opening remarks. Mairead, it is wonderful to see you. We're so pleased to have you here. I'll turn things over to you now.
Thank you so much, Catherine. Always a delight to see you. And thank you to the Chamber for this opportunity to introduce our keynote speaker today. Like all of you, I am extremely excited to hear the thoughts of Governor Macklem, particularly at this critical time. In fact, the timing of this entire event could not be more appropriate. Today's agenda is about the future of economic growth, the digital economy, infrastructure, even the future of work itself. And this is a really important time to be talking about these subjects because for the last 2 years, the future has seemed like an extremely distant place. For so many businesses today, particularly small and medium-sized companies, it has been difficult to think beyond next week or even tomorrow, let alone plan for something as big and far away as the future. And it's not just the pandemic that has been stress testing our ability to plan. Events have rocked our perspectives on human rights and social justice, not to mention the future of our planet's climate. All of these challenges have had and will continue to have a tremendous impact on the way forward, affecting public policy decisions, as well as corporate and personal choices for businesses, consumers, and families. So thank you to the Chamber and the organisers of this Canada 360 event for giving us this opportunity. Now is exactly the time we should be thinking about the future. And that's something that we're very preoccupied about at EDC. The questions, particularly questions that involve Canadian exports. And looking to the future requires a very clear-eyed look at where we are today. And presently, as an exporter, Canada underperforms. Relative to our OECD peers, our share of global exports has been in decline for the last 2 decades. And this underperformance comes at a cost. Just closing the gap between our share of global exports and the OECD average over the last 20 years would have delivered an additional $165 billion in Canadian exports for our economy. Ironically, some of the trading regions where we underperform are areas where we have the most advantage, whether that be geographic proximity or pre-existing trade agreements. For example, it includes Germany, the economic engine of Europe, as well as numerous markets in Asia and the Pacific Ring. But it also includes the United States, our neighbour and partner in the Canada-US-Mexico trade agreement. EDC's own economics group calculates that meeting our export potential with just the US and China would deliver more than $30 billion in annual exports to our country's trading portfolio. Many of the obstacles to these are familiar to you all, particularly those hurdles which have appeared over the last 2 years. Supply chain issues, labour shortages, and inflation, to name just 3. In the near term, supply chains continue to be a major concern. The trajectory of this challenge depends first and foremost on the trajectory of the Omicron variant and the pandemic more broadly. But it is also, interestingly, a challenge that has been aggravated as much by a demand explosion. The US Commerce Department, for instance, reports that in 2021, the United States economy grew 5.7%, its fastest year of growth since 1984. Even fully functioning supply chains unencumbered by a pandemic would be challenged to keep up with that rate of growth. Related to the supply chain issues are labor shortages. COVID-19 has played havoc with the global workforce, production lines, and transportation systems. But the pandemic has only aggravated a challenge that was emerging long before 2020. Evidence of labor shortages across a spectrum of skills and roles in the global economy predated COVID-19 and will require a much larger policy and investment approach. And as for inflation, well, both the Bank of Canada and the US Federal Reserve have already signaled their intentions. And we will all be watching closely as central bankers around the world make their decisions. Today, we are extremely fortunate to be joined by Canada's own chief central banker and one of this country's most influential decision makers. As I said a moment ago, looking at the future requires having a clear-eyed understanding of our present. And we could not have a better guide today to help us with that understanding. Beyond his distinguished career at the bank, Tiff Macklem has a long history of public service and private sector experience that has spanned some of this generation's most consequential events. During the financial crisis of 2008, he served as Associate Deputy Minister of the Department of Finance and acted as Canada's representative at the G7, G20, and the Financial Stability Board. And his appointment as governor took effect on June 3rd, 2020, just months into the global pandemic and the economic crisis that persists today. I know that all of us are extremely grateful to the governor for taking this time to share his thoughts with us this afternoon. And with that, it is my very great pleasure to introduce our keynote speaker, the Governor of the Bank of Canada, Tiff Macklem.
Well, thank you, Mairead, and thank you for that introduction. You've done a wonderful job, I think, of setting the stage, and it is a real pleasure to join this summit to talk about the economic recovery. I'm particularly pleased to be here to discuss the challenges Canada must overcome to sustain strong growth. And when I say sustain strong growth, to be clear, that means non-inflationary growth. As you just said, there is no better time than now to have this discussion. Our economic recovery from the deepest recession on record has been strong. Canadian businesses and workers have shown impressive ingenuity and resilience. Employment is robust, household savings are high, and immigration is rebounding. As we emerge from the COVID-19 pandemic, Canada has the opportunity to make long overdue gains in productivity. In the years ahead, business investment decisions will determine the path of Canada's productivity growth. And productivity growth is vital to non-inflationary growth and rising standards of living. At a time when inflation is already well above our target, this is more vital than ever. En sortant de la pandémie, le Canada a l'occasion de faire des gains de productivité attendus depuis longtemps. Dans les prochaines années, les investissements des entreprises vont déterminer comment la productivité va évoluer au pays. C'est essentiel de renforcer la productivité pour avoir une croissance non inflationniste et améliorer le niveau de vie. Et avec l'inflation qui dépasse beaucoup la cible, c'est plus essentiel que jamais. Today, I'd like to talk to you about two things. First, I want to unpack what is behind the Bank of Canada's latest economic projection and explain why we expect a pickup in investment and productivity growth. And second, I'd like to outline the path to get there, crossing a bridge from the ingenuity we've seen through the pandemic to long-term productivity growth. Canada has come through the pressure cooker of the pandemic with impressive resilience, and critical business investments in digital technologies were an important element of this success. Those of us who could shifted to remote work. Almost everyone's learned how to buy and sell online, and many businesses have shifted supply chains as borders closed. In January of 2021, during the second Canadian lockdown, 1/3 of Canadian employees worked most of their hours from home, and that compares to just 4% in 2016. These digital investments have been essential to sustaining our economy through the pandemic. Of course, the pandemic has also held productivity back for a variety of reasons. Disruptions to global supply chains have made it harder for businesses to get critical inputs, limiting productivity of labor and capital. Public health restrictions have necessitated more people and space to do the same work, and rapidly changing circumstances have made it hard to plan and operate efficiently. As the pandemic fades, these forces should dissipate, creating the opportunity to increase productivity. There are two fundamental sources of growth in gross domestic product: more workers and more output per worker. We call output per worker productivity. We measure workers by total work hours worked, which is the product of employment and average hours worked. We call this labor input. And we measure productivity as output divided by labor input. Now, comparing Canada and the United States through the pandemic and recovery, we see that Canada's rebound in employment has been considerably stronger. But workers in the United States have increased their hours of work much more than workers in Canada. What that means is that the recovery in labor input has been quite similar in both countries. The difference lies in productivity. Productivity growth has been considerably stronger in the United States. So with roughly the same recovery in labor inputs, the United States has seen a larger increase in output. So why? Well, there appear to be two related factors. Public health restrictions have been more comprehensive in Canada, causing temporary restraints on economic activity. As we emerge from the pandemic, we should make up this difference. But the second reason could have more lasting consequences. Business investment through the pandemic has been considerably stronger in the United States than in Canada. Indeed, U.S. businesses have long been investing in more capital per worker than Canadian businesses have, and this gap has widened over the past decade. The share of investment in ICT equipment has also been lower in Canada, and this gap has widened too. This is significant because research shows that ICT investment has played an important role in driving productivity growth. In addition, research shows that capital in the United States has moved to higher productivity sectors in larger amounts than it has in Canada. In other words, capital in the US has been more nimble. The question is, does COVID-19 provide us with an opportunity to change our course? I believe it does. In our projection, we expect business investment in Canada to pick up. Corporate balance sheets are generally strong, and companies are increasingly reporting that they are facing capacity constraints. In addition, consumer demand is expected to remain robust, and U.S. demand for our exports is strengthening. In our most recent Business Outlook survey, 62% of firms reported that they are planning to spend more on machinery and equipment in the year ahead. This is the highest reading since we started the survey in 1999. This all points to solid growth in business investment in Canada. Indeed, we expect that business investment will grow faster in Canada than in the United States. It's imperative that businesses in Canada follow through on these plans, or they risk losing out to U.S. competitors. For the economy as a whole, investment is critical to non-inflationary growth. In our projection, productivity growth rises as pandemic restrictions ease, supply chain bottlenecks dissipate, and companies return to more efficient operations. To sustain this rise in productivity, we need business investment to pick up. With the labor market already tight and wages rising, productivity growth is vital to economic growth and to increasing wages without raising unit labor costs. In our forecast, productivity growth in Canada closes in but remains below U.S. productivity growth. But I suspect our forecast does not do justice to your ambition. And as much as we'd like to get our forecast right, we would be happy to be surprised by the strength of investment and productivity. So how do we get more growth without inflation? The short answer is by investing in capital and in people, and by confronting our weaknesses and playing to our strengths. I believe an opportunity exists to build a bridge between the short-term changes Canadians have made to cope with COVID-19 and the sustained investments that will grow our economy and improve our quality of life. Let me expand. The pandemic has pulled forward digital investments. It's pulled forward the digital economy. With more firms and consumers using more digital infrastructure, related jobs have multiplied. These digital investments need to continue. The other element is investing in people. The public and the private sectors share this responsibility, and it's a strength for Canada. Our strong labor market participation rates, high levels of immigration, and the access to quality education in Canada are long-standing advantages for us. The pandemic presents an opportunity to build on these strengths. Remote work is one of the most visible changes wrought by the pandemic. It has created challenges for workers, families, and employers alike. But as new, more flexible work arrangements become embedded, we are expecting productivity gains. And the productivity of remote work will likely rise further as innovation continues. With sustained investment in technology that enables remote work and innovations in new ways of working, businesses can both raise their workers' productivity and expand their access to new workers who value flexibility. Throughout the pandemic, parents, particularly mothers, were affected disproportionately, and challenges of childcare disruptions remain. But in Canada, by the end of last year, the female labor market participation rate had returned to pre-pandemic levels. By this metric, the so-called she-session has largely recovered. Businesses in Canada have an opportunity to lean into this bounce back in female participation and leverage new ways of working to attract more women. The Government of Canada's new Universal Childcare Program has the potential to improve access and reduce the cost of daycare. This should support higher labor market participation of parents, particularly women. More broadly, with labor markets already tight, we know that businesses are going to have a harder time hiring workers. Companies need to reach into underutilized communities to attract more diverse workers, not only because they need the workers, but also because diversity will benefit their business. The digitalization trend accelerated by the pandemic may boost labor force participation among those who can't balance standard work hours or locations with other demands in their life. Increased immigration also provides an opportunity to add workers and skills. While the pandemic cut immigrant flows nearly in half in 2020, Canada met its ambitious immigration target for 2021, and further increases are projected for 2022. Education has also been a challenge through the pandemic, but we can't afford to lose our education edge. In 2020, 60% of Canadians had a college or university degree, compared with 50% of Americans, though in Canada we do lag in advanced degrees. University enrollment in Canada by young adults has increased during the pandemic. That's encouraging. And enrollment in university science, technology, and engineering and math, so-called STEM programs, has been increasing over time. Businesses, too, have a critical role in training and in preparing workers for new digital technologies. New online learning platforms have reduced the cost, improved the flexibility, and expanded the reach of learning. Businesses must also be willing to pay up for talent, and that comes back to productivity. Higher productivity pays for higher wages. Workers, as well as the public sector, also play critical roles in expanding our economy's growth potential. Workers must be prepared to update their skills and retrain throughout their careers, with the help from both their employers and the public sector. Universities and colleges need to continue to expand STEM programs and extend the development of digital and entrepreneurial skills more broadly. Governments have to help get people launched and support business and opportunity. I hope we can dig more deeply into these challenges in the discussion that we're about to have. But before we do that, let me conclude with the Bank of Canada's role. We have a responsibility to deliver low, stable, and predictable inflation, so Canadians can plan and invest with confidence. At close to 5%, the current rate of inflation is too high. This is well above our 2% target. How did this happen? It's not the result of generalized excess demand in the Canadian economy. Our economy is only just now getting back to full capacity. The inflation we are experiencing today largely reflects global supply problems, most of which stem from the pandemic. With many services shut down, households around the world bought goods instead. But the pandemic has impaired supply chains, holding back both production and transportation. The result has been sharply higher prices for many goods. Oil prices have also risen, and food prices are being boosted by poor harvests. While uncertainty remains, there's some evidence that global supply chain problems may have peaked. As the pandemic recedes, conditions around the world should normalize, taking pressure off global goods prices. As this happens, we expect inflation to come down relatively quickly in the second half of 2022 to about 3% by the end of the year. But to get inflation the rest of the way back to its 2% target, we need a significant shift in monetary policy. That's why in January, we removed our exceptional commitment to hold our policy rate at its floor of 0.25%. And we told Canadians they should expect interest rates to increase. The bank's governing council agreed that the economy will need higher interest rates to moderate growth in spending and bring demand in line with supply. We also agreed that we must keep inflation expectations well anchored. If inflation expectations become unmoored, the cost of getting inflation back to target will be much higher. For both these reasons, we signaled with unusual clarity that Canadians should expect a rising path for interest rates. So what can businesses expect from us? We will continue to act deliberately and communicate clearly so monetary policy is a source of confidence, not of uncertainty. And as businesses set prices and wages, firms and workers alike can be assured that the Bank of Canada will use its monetary policy tools to control inflation. On va continuer de prendre des actions bien mesurées et de communiquer clairement. On veut que la politique monétaire soit une source de confiance et non d'incertitude. Alors qu'elle fixe les prix et les salaires, les entreprises, tout comme les travailleurs, peuvent être sûrs que la Banque du Canada va utiliser ses outils de politique monétaire pour contrôler l'inflation. Your business decisions have important implications for the performance of the Canadian economy. Your ingenuity and willingness to invest in digitalization have laid the groundwork for productivity growth. Now we need to turn that short-term success into long-term growth. Canadians count on the Bank of Canada to control inflation, and they count on businesses to invest in capital and in people to grow our economy. So let's discuss the issues and consider the solutions together. Thank you.
Governor, thank you very much for a fascinating presentation. I should mention to everybody that if you would like to see a copy of the Governor's text, all of the text and graphs that were delivered by him are available on the website of the Bank of Canada, which is www.bankofcanada.ca. I'd also like to mention that I'll start the conversation with the Governor by asking a few questions, but we also want to give you the opportunity to participate. If you'd like to do so, please submit your questions by clicking on the question and answer button below the stage. Well, Governor, thank you so much for that presentation, which was a remarkably optimistic presentation in terms of the potential for Canada, and one that is also very direct and forthright in terms of what we can expect. I guess let me start first with your confidence with regard to Canada's competitive abilities, and particularly our ability to improve our productivity in Canada. You've seen many reports over the course of the last while indicating that Canada's long-run trend GDP growth has been generally declining in recent decades. The most recent report to look at that was one of the Senate Prosperity Action Group, which was predicting that we would continue to see a decline in terms of Canada's GDP growth over the course of the next several years. It's also clear that during this time, our relative performance among advanced economies has been disappointing on metrics like labor productivity, business investment, and you particularly cited machinery and equipment, research and developments in other areas. as well as on international trade, as Marie mentioned earlier. What gives you the confidence that this is different, that we can do much better? And what do you see as the opportunities for Canadian companies to be able to improve on our long-term economic growth?
Well, thanks for the question, Perrin. In my remarks, I did highlight what I think are some of the core advantages that businesses have in Canada. We've seen a great deal of ingenuity through this pandemic. Businesses have demonstrated they can be adaptable, they can be nimble, and the investments we've seen in digitalization have been critical to getting us through this pandemic. We have a talent advantage in this country. We have a very well-educated workforce. We have an inclusive labor force with high levels of participation. But let me step beyond to some other advantages, which I didn't mention in my prepared remarks. Natural resources, agriculture, forests, oceans, minerals, energy. We are a richly endowed country, and the opportunities are shifting, but the opportunities in natural resources continue to be there. The other one I would mention, and this might surprise some people, but science. Sometimes we don't think of ourselves as leaders in science, but look at some of the biggest developments in science today: artificial intelligence, quantum computing, medical research. Canada has leading scientists. Yes, we need to do more to commercialize that science and create scaled businesses, but we're very good at science. Another one I would highlight, and Marie mentioned this actually, trade. We have among the best market access in the world between, if you want to call it CUSMA or USMCA, but our trade agreement with the United States, CETA with the European Union, the largest market in the world, the CPTPP with a number of Pacific countries, as well as a number of bilateral trade agreements. There is more we can do to leverage those trade agreements. Look, businesses, I think there are opportunities to find new markets. I know Marie and EDC will be happy to help them. Part of that, and I know you've spoken a lot about this, part of that is we've got to get our products to market. So that requires key infrastructure investments so we can move goods in this country, ports, railways. Canada also needs to maintain a strong voice at the international table in support of rule-based trade. I don't think your businesses need advice from the Bank of Canada on how to take advantage of these opportunities. Your members know their businesses better than anybody else. But the way I would describe it is in three buckets. The first bucket is markets for our products. And that is about leveraging our trade agreements. Earlier this week, I had a roundtable with Atlantic exporters. And they had a number of great examples of how businesses in Atlantic Canada are leveraging the new CETA trade agreement with Europe to find new markets for some of their products. The other element I would highlight is supply chains. Supply chains are very disrupted right now. That should ease, but supply chains are shifting. I think most of your businesses, they're probably thinking about how am I going to improve the resilience of my supply chains? And what we're hearing is some businesses are diversifying their supply chains. Others are making them more local, more regional. Getting embedded in those shifting supply chains is going to be a critical way to finding new markets for our products. The second bucket is new products for our markets. So let me go back to natural resources. There are opportunities to use develop our natural resources and create new higher value products. And give you a couple of examples. Structural wood. BC has been a real leader in building this new structural wood, replacing steel and concrete. It's more environmentally friendly. You can build a 15-story building now in structural wood. There are lots of opportunities in plant-based proteins, plant-based foods. Demand for that is going up. We've got opportunities there. Moving to one of the before the pandemic, one of the fastest areas of growth of our exports was actually in services. And there are opportunities in engineering services, in technology. Our biggest cities, Montreal, Toronto, Vancouver, are increasingly becoming technology hubs. And then the last bucket, really, which is what I focused on in my remarks, is competing to win in global markets. And that is about improving our productivity. And that is going to require more sustained investment in machinery and equipment, particularly ICT. And it's going to require investing in workers. So I'm not going to pretend it's going to be easy. There is a lot of uncertainty out there. It is tough making bets, but our competitors are not standing still. We have some advantages, and I do think there are good reasons why we can improve the course going forward.
Governor, if you'll permit me, I want to pursue that if I could, please. You've cited a number of advantages that Canada has, whether it's in terms of quality of our education, other support systems, the incredible natural resources, our trade agreements, and others. And by any objective standard, we Canadians are the most fortunate people in the world. And yet, prior to COVID, our performance was poor. We lagged others in terms of productivity growth and in terms of investment and in terms of growth of GDP. I guess the fundamental question is this: what has changed? Why are you more optimistic that we can break free of the growth trap we were in prior to COVID?
I'd highlight two things. First of all, while our productivity growth has been disappointing, our actual GDP growth has been really quite good. And if you compare us more to other countries, what you see is we've grown more by drawing people into the labor force, by hiring workers. And that reflects some of those advantages I talked about: well-educated workforce, a more inclusive labor force. And there are still opportunities to grow. The participation of women, it has continued to come up. There is room to increase female participation rate further in the market. There are opportunities to draw workers into the labor force. So, but those opportunities are not. I mean, labor markets are tight. Companies are finding it increasingly hard to find workers. We've got an aging society. Our labor force is not going to be growing as fast going forward. It's already, the growth of our labor force is already slowing. We are not going to be able to rely as much on growth in the labor force. So that shifts the incentives for companies. There is a bigger need now to increase output per worker because it's going to be harder to get workers. The second reason I'm optimistic is that we beat ourselves up sometimes in Canada. We don't take as much risk. We're not as nimble. We're more cautious. Well, I think Canadian businesses have demonstrated through the pandemic they can be very nimble. They can be very adaptable. They can pivot quickly. They can invest, and those digital investments have really been critical to getting us through this pandemic. So. Canadian businesses we've all been through a lot of change, and I think it's starting to feel, we don't like it all, but it is feeling a little more natural. There is an opportunity to keep moving faster, and we've developed some new muscles, and let's keep using them.
Thank you, Governor. Could we turn to long-term monetary policy? You've underscored that Canadians can be confident the Bank of Canada will control inflation. You've made that very clear again today. And you've been very candid, as the bank has been, that Canadians should expect that interest rates will start to rise and that you're fully committed to bringing inflation back on target. There are multiple parts to monetary policy normalization. It has already meant the end of emergency forward guidance measures. And you've been clear that over time, as I mentioned, interest rates will rise, eventually returning to a more neutral level. But one area that's less clear is the future of the bank's asset repurchase programs and the impact that these so-called unconventional actions have had on the economy. Looking out beyond the pandemic, have unconventional tools like quantitative easing now proven their worth to be moved into the conventional part of your toolkit? And do we have a sense yet of the longer run size and use of the bank's balance sheet in pursuit of your mandate?
From the start of this pandemic, Perrin, the Bank of Canada's response was very forceful, and it combined both conventional monetary pool tools with our extended toolkit. There was a clear need to be extremely forceful, and when we went into this, we went in boldly. We also were clear on the conditions for exit. So, from the start, we launched we lowered the policy interest rate to effectively zero. We launched a whole series of liquidity and purchase programs to restore market functioning. And when we did that, we indicated from the start that when market functioning was restored, we would end those programs, and we did. By the end of 2020, those programs were pretty much wound down. In July, my first decision as governor, we articulated exceptional forward guidance. We would hold the policy rate at the effective lower bound until slack was absorbed so that we would sustainably achieve the 2% inflation target. And we reinforced that with large-scale purchases of Government of Canada bonds, quantitative easing. And we indicated at that time that we would continue quantitative easing until the recovery was well underway. As the recovery progressed, we began tapering QE, and as you mentioned, we ended it last October. And then a couple of weeks ago, we removed the last element of our emergency policy. We removed the exceptional forward guidance and signaled to Canadians very clearly that interest rates would need to increase. These various elements of the policy response worked effectively together. By lowering the policy rate to its effective lower bound, that pulled shorter-term interest rates down. By signaling through exceptional forward guidance that we were going to hold the policy rate low for a considerable period, that pulled rates down further at the term structure. So those are the rates, 2, 3, 4, 5-year rates that your members are borrowing at. And then quantitative easing further reinforced that by buying bonds out the curve that further pushes up their price and pulls down their yield. Again, further bringing down the interest rates that businesses are borrowing at. And I don't want to take too much credit. Monetary policy was one part of the response. The most effective part of the response has been vaccinations to immunize us from this pandemic. But monetary policy in combination with fiscal policy has been very effective. We've had a very robust recovery. There are certainly still parts of this economy that are being affected, but when you look at it overall, the economy has recovered. So these tools have worked, and we've shown that we can get in, come in boldly, and we can get out, and that exit has actually gone relatively smoothly. So looking to the future, we renewed our mandate with the Government of Canada in December. I think that both there was demonstrated continuity. The policy, the target remains 2%. As part of that, we did clarify the tools that we can use, and I hope it is some time before we have to use our exceptional tools again, but they're there, and if we need to use them again, we will.
Governor, in your remarks, you pointed out the fact that the inflation that we've been experiencing at the present time is less a matter of the economy overheating because of increased demand than it is because of constrictions on supply chains, both domestically and internationally. Some of this we can control in Canada, some of it, for example, the maldistribution of shipping containers, we can't. Are you satisfied? You indicated that we're starting to see at the global level that supply chain constraints are starting to ease. Are you satisfied that we are doing everything that needs to be done within Canada to address the elements of supply chain problems that we have within the country itself?
Well, let me just start with some of the global evidence. It is, I would stress, it's early days here, but If you look at supplier delivery times, if you look at transportation costs, they do look globally to have at least stabilized and perhaps come down. I would stress that look, they're still elevated. We talk regularly to businesses. Certainly, they're telling us they expect it's going to take some time for these to normalize. There are large backlogs of orders, and look, the virus is still out there. There are still new mutations. There are still risks of localized outbreaks, which could cause shutdowns and further gum up global supply chains. But I think there is, globally, we are seeing a lot of investment. There's a lot of focus. Companies around the world are using that ingenuity I talked about to find new suppliers, to hold more inventory so they don't get stuck. Companies are responding. Governments around the world are responding. I think looking at Canada, there's quite a bit of focus, both provincial and federal levels of government, on our ports. Those are key entry and exit points for our goods, and I think improving the throughput there is going to be important. And I think even before the pandemic, there were capacity issues at our ports. There was already plans to expand some of our ports, particularly Vancouver. The government has announced some increased funding immediately to try to accelerate some of those. Certainly what we're hearing from business, it's ports. It's also then getting from the port onto the rail car or onto the truck. It's every piece. And certainly what we've heard from businesses is, they're looking at sort of multiple ways of getting the inputs they need, as well as to getting their product to market. It's going to take some time for this to ease, but I think we can be confident that particularly as a lot of this is related to the pandemic, and there's two elements of that when I say it's related to the pandemic. One is it's the pandemic itself is impairing production and transportation. The other element, though, is because we're unable to consume a lot of the services we want during the pandemic, consumers have shifted in a big way into goods, and that's happening around the world. Goods, of course, have to be physically produced, manufactured, they have to be shipped, they have to be delivered. As the pandemic recedes, we are expecting demand to shift back more towards services, and less demand for goods. And we are starting to see a little bit of evidence of that. Certainly, as the economy reopened through the latter part of last year, you saw a big surge in demand for services and starting to come off on goods. As we come out of Omicron, we expect to see that. Globally, we expect to see that. That should take some pressure off at the same time as the logistics improve. But yes, we are going to need continued investment, and not just to get us through the pandemic, but to be able to get our products to market globally.
Thank you. We're getting questions from our audience. Let's turn to some of those. John asks, what would the future scenarios look like for interest rate increases if A, another variant shut us down again, or B, if COVID regresses and we begin to reopen with vigor and do not shut down again?
Well, what we've said is that Canadians, businesses, should expect interest rates to be on a rising path. What does a rising path mean? A rising path is not one increase in interest rates. A path really suggests multiple increases. But I would stress that a rising path doesn't mean we're on autopilot. We'll take those decisions at each point. really suggests multiple increases. But I would stress that a rising path doesn't mean we're on autopilot. We'll take those decisions at each point. We're all spending a lot more time at home. We're working at home. Our children are studying at home. Most of our recreation's at home. People want more space. As the pandemic eases, I think you can expect that that demand for space, more space, will come off a bit. The other element is interest rates have been very low. That has made the cost of that has reduced the cost of borrowing, and that has been a factor that has contributed to demand for housing. We've signaled very clearly that interest rates are going to be on a rising path. And if you look at our own projection, what we have in our own projection is we are expecting housing activity will remain strong. Job growth is strong, wages are going up, Canadians have good incomes, so immigration is rebounding. So there are some sustained elements of demand for housing. So we are expecting housing demand to remain strong. Having said that, we do expect it to gradually come off the very elevated levels it's been, reflecting some normalization as we come out of the pandemic, and the fact that interest rates will be on a rising path. The other thing I would say is that when you look at household balance sheets, we have been concerned, particularly in a market where you've seen rapidly rising housing prices, that some Canadians are stretching. They think that these housing prices will continue, and so they're stretching to get in the market. And there have been some measures taken to try to protect against that. The OSFI and the Government of Canada put in a stress test with a floor, so that basically builds a bit of a buffer in, recognizing that when interest rates are ultra low, they can only go up. So there's some buffer that mortgage holders have. The other thing is that if you look at Canadians' balance sheets overall, they've actually improved through the pandemic. Because Canadians haven't been able to buy many of the services they want, their actual savings have gone up. And they've accumulated roughly $200 billion of what economists call excess savings. While that's not every Canadian, on average, Canadian balance sheets are stronger. And what are Canadians doing with that money? Well, so far they've actually been behaving really very prudently. They're paying down their credit cards, they're reducing their debt, and they have been keeping a lot of that money in the bank. So that again provides some buffer for Canadians.
When you look at, just to follow up on what you were saying, when you look at the excess savings that Canadians have, the suggestion would be that we do not need the government to stimulate the economy further and to prime the pump. Am I correct on that?
Certainly what it means is that, they're unlike where we were a year ago, or certainly a year and a half ago, the demand is much more self-sustaining now. People have jobs, they have incomes, and then on top of that, you're right, they've got this extra savings. So in our own projection, we're assuming that they spend some of that extra savings. We went out and we surveyed Canadians. We asked them what they're going to do with the money. And based on that, we're assuming that they're going to spend about 20% of that extra savings. So as things normalize, we expect their savings rate will come down to more normal levels. And in addition to that, there will be, they'll spend about 20% of that excess savings. So if you look at our projection, we have a strong consumer-led recovery. I think an important message of my remarks, though, is that to sustain a strong consumer-led recovery, you need investment, you need productivity, because we've got to build the supply capacity in the economy to absorb that demand. And so, whether it's it's businesses or governments, what we need is more focus on building that supply capacity than on demand is now looking self-sustaining.
Another question from the audience. What are your thoughts on commodity inflation from global decarbonization, such as copper, lithium, carbon pricing on fuels? How will the physical world meet the practical aspirations of environmental targets while limiting commodity inflation?
That's probably a whole other speech, Perrin. But let me just say a couple words about the work that we're doing at the Bank of Canada on this. Look, there is a lot of uncertainty around what the transition to net zero growth is going to look like. Clearly, we've never done this before, and you can't use historical data. But we can't be paralyzed by this uncertainty. We do need to move forward, and so one of the things we've been doing to help, particularly the financial sector, better price climate risks and better channel the allocation of capital is to use a fairly elaborate model of the Canadian economy to run climate scenarios. We published this in January, so they're scenarios, they're not predictions, but they do give a sense of possible outcomes. And what comes out of the scenario analysis is really in all the scenarios, there's going to be a lot of adjustment required in the Canadian economy to transition to net zero growth. And much of that, some of that is driven by policy within Canada. Much of it, though, is driven by what's going on in the rest of the world. As the rest of the world transition, as the prices of fossil fuels diminish, our terms of trade turn against us, and there are both sectors that win and sectors that lose. But what you see is there's a lot of adjustment, and that adjustment is on a scale that will have macro consequences. So from a monetary policy perspective, that is something that we're going to need and we are going to be devoting more attention to. It's difficult to in the different scenarios, what you see is there are different possible outcomes. I think the other thing, though, that is clear is that the longer we wait to start to transition, the more abrupt and the more painful that adjustment will be, and the more risk that there'll be a rapid repricing of assets that could lead to some stress in the financial system. So it is important to move forward deliberately and get on the path and sort of keep building the momentum so that it can be as smooth as possible.
Another audience question. Canadians appear good at innovation and research, but also do not seem to hold on to their intellectual property. Is this a primary long-term risk?
Perrin, we have a long history of great inventions in this country that get commercialized south of the border, and too many of the benefits flow south of the border. This is something, my previous job, I was Dean of the Rotman School of Management, and this is something that I really worked on. I was sitting in the middle of U of T. Jeff Hinton's across the street, one of the founders of deep learning, a global leader in AI. We've got the Quantum Center at University of Waterloo. University of Toronto is surrounded by some of the world's leading hospitals, medical research, and I picked Toronto because that's where I was, but it's not there are other key hubs in Canada. And what you're seeing in Canada, I think, is there is a shift here. We are building that ecosystem. I would say in the last 15 years, we've become much better at startups, and you've seen a huge growth in startups. The focus now is shifting to scale. We've been very good at starting companies, and we've been very good at selling those companies to bigger companies, and the founders of those companies are doing quite well. what we need are more companies that actually can achieve scale in Canada. And we have some in Canada. We need more. And what I'm seeing is that ecosystem is much improved. And we just need to double down on that. And it takes a few things. But if you look at where we are today compared to where we were even 10 years ago, I do see a big change.
Now, sadly, we're rapidly running out of time, but do you have time for one more question from the audience?
For sure.
Wendy asked this, how does the growth that we've been talking about, especially if we're able to increase our exports, balance with a reduced carbon footprint and environmental sustainability?
Well, I talked about new products for our markets. And I think one area which I didn't mention, which I should have, is clean energy. If you come back to those Bank of Canada simulations or scenarios, so we took pretty conservative assumptions about technology. It's very hard to predict the speed that new technologies are going to come online. But we did run some scenarios with different assumptions about how quickly technology progresses. And I can tell you, if technology progresses very slowly, it's going to be much more difficult to get to where we need to get to. Technology innovation is a big part of solving climate change. Canada already has some great clean tech companies. We've come up with some very innovative solutions. This is something, by growing this space, this is something Canada can do to solve its own problems, but it's also something Canada can do for the world, and it's something we can do to help grow our economy. So I don't want to pretend that this transition is going to be easy. It's not. But I do think there is a key element of opportunity, and I think it is going to be a growing, it needs to be a growing part of our future.
If I read you correctly, what you're saying is these aren't polar opposites, that we are capable of both growing our economy and protecting our environment if we do it wisely.
Yes, absolutely. This is a big adjustment. It is a big supply shock. Some of the capital we have is going to have to be retired. We're going to have to invest in new capital, new technologies, new businesses. But yes, the opportunity, carbon is getting repriced. The global demand is shifting. Consumers are increasingly looking at the carbon footprint of their behavior. Businesses are increasingly looking at their supply chains. That is creating opportunities for Canadian businesses, and Canadian businesses need to be alive to that.
RBC was projecting that in the transition to net zero, the cost would be up to $2 trillion, I believe. Do you see this transition primarily as a cost to the Canadian economy, or is it an opportunity that we can benefit from and that we can improve our competitiveness from?
Well, Perrin, look, there's a cost. Let's not kid ourselves. There's a cost, but we're going to bear that cost. We're going to bear that cost one way or the other. So, let's seize the opportunity in our own scenarios. As I said, there is a macro level cost. It's about 10% of GDP. Now, that's only a partial scenario. We didn't include, for example, the costs of more extreme weather events and the physical costs of climate change. So obviously, if you can mitigate those, you're going to have a benefit. If you don't mitigate those, you're going to have a bigger cost. So that number should be, that number is certainly not definitive, but that's 10% of GDP relative to a growing path between now and 2050. So it means that the path is lower than it otherwise would be, but it's still an upward sloping path. And it has in that path, remember it's a scenario, it has pretty conservative assumptions about technology and innovation. That number could be significantly less if we have more innovation than is built into our, or deliberately, I would say, adverse scenarios. We're trying to see, the purpose of these is to sort of come up with stress scenarios to see, if we don't take the actions we need, how much repricing might you have to have? What could the consequences be of that? So, yeah, there's a cost for sure. There's an opportunity, and the more we seize the opportunity, the less is going to be the cost, and the more is going to be the benefit.
Governor, thank you so much. Thank you, first of all, so much for being with us today with so much uncertainty in the world right now, with so many factors that have been affecting the Canadian economy. Everyone in our audience was greatly looking forward to receiving your insights. And I want to also express on behalf of the business community our appreciation of the job that you and the Bank of Canada have done during this very turbulent period. As Maureen mentioned, you took over the bank at possibly the most challenging possible time as we were sliding into the pandemic. And your work as governor of the bank has contributed enormously to the success of the Canadian economy during that time. And we're grateful for that. Thank you again so much for being with us today.
Well, thank you for inviting me, Perrin, and I will take that back to all my colleagues at the Bank of Canada. Thank you.
Bonjour tout le monde, je m'appelle Paul Botticher et c'est un plaisir de vous accueillir à cette conférence de presse. Good afternoon, everyone. Thank you for joining us for today's press conference with Governor Tiff Macklem. Governor Macklem will be pleased to take questions for about 20 minutes, but before we get to your questions, some quick housekeeping notes. I'll ask everyone to please limit yourself to one question and a quick follow-up so that everybody who wants to ask a question can do so. I'll also ask everyone to kindly make sure your line is muted. If you're not asking a question, you can do so by pressing *6 and unmute. By pressing *6 again. Pour mettre votre ligne en mode discrétion, appuyez sur étoile 6 et pour l'enlever, faites étoile 6 encore une fois. Et bien sûr, libre à vous de poser vos questions dans la langue officielle de votre choix. And if I fail to identify you when I call on you, please state your name and affiliation. So with that, we'll get going. And our first question is going to be Dave Parkinson of the Globe and Mail. Dave, go ahead, please.
Thanks, Alex. Good afternoon, Governor. Sorry, I'm getting an echo on my line. I apologize. In the speech, you obviously talked a great deal about the need for productivity, enhancing investment, not a lot about what public policy can do about that. Obviously, touched a little bit on what the bank itself does to sort of set the stage for it, but is there a role, a significant role here that you see for government policy in terms of stimulating or encouraging the kind of investment that you're talking about? And is that something that's been missing from the equation over the last, frankly, decades?
Well, I was speaking to a business audience, Dave, so my remarks were principally addressed to the business community. I certainly did underline that there is a shared responsibility, and governments certainly have an important role to play. Governments have played a very important role in getting us through this pandemic at the provincial, at the federal level. Monetary policy has also played a critical role for the and certainly when you look at government policies, their emergency support programs have wound down as the pandemic has receded and people have got back to work. Monetary policy has also wound down, and as we announced a couple of weeks ago, we've now moved off all our emergency policy settings. With respect to the go forward, look, I'm going to leave government policies to our elected officials, but I think the one thing, the core message to business was we need to build supply capacity in our economy. Investment productivity is critical to growing our economy while getting inflation down. If we don't get that productivity growth, if we don't get that investment, we won't be able to grow the economy as much and get inflation back to target. And similarly, I think public policy needs to focus more on the supply side, and whether it's the supply of housing, the investments in key infrastructure to move goods across this country. There are particularly as the economy now is back to capacity, then there is a greater need to focus on the supply side, both in government and in business.
And on that note, do you feel like there's been a tendency for business in this country, and you've talked about how we have underinvested, at least compared to our American counterparts. Has there been an inclination by the business community in this country, you think, to lean more on labor investment as opposed to capital investment?
So in Canada, we have grown more by hiring people, and that has been good news in many respects. We have higher rates of labor market participation. We have a more inclusive economy. We've created a lot of jobs for Canadians. I think as we look forward, labor markets are tight. Companies are having a hard time filling all the vacancies. Our population is aging, so that means the new generation of workers coming into the labor force is smaller relative to the generation of workers, the baby boomers that are retiring. So our labor force growth has slowed and is going to continue to slow. So what that means going forward is to achieve the kind of growth that we're aspiring to as a country, and to achieve the rising standards of living that we're all hoping for, we're going to have to rely more on productivity growth going forward and less on labor force growth. We're certainly going to need both, and there's room for both, but we're going to need relatively more productivity growth to sustain growth in GDP.
We'll go now to Michelle Zadikian of BNN. Michelle.
Hi there. If business investment starts to weaken as the rate hiking cycle gets underway, would you pause further rate hikes?
Well, first of all, let me just underline, there are a number of good reasons to expect business investment to be quite strong. I think, first of all, the table is set. Business balance sheets are generally healthy. Businesses are reporting to us that they are running up against capacity constraints. If they want to meet demand, they're going to have to add to capacity. Consumption growth is growing robustly. Our exports to the U.S. are strengthening. And perhaps most importantly, when we go and ask companies about their investment intentions, they're strong. In fact, they're stronger now than they've been since we started our bank business outlook survey in 1999. So, over 20 years ago. It's the strongest it's been. So I think we have every expectation that we are going to see solid business investment growth. In terms of, we've been very clear with Canadian businesses, interest rates are ultra low. The need for ultra low interest rates has passed. businesses, Canadians can expect interest rates to be on a rising path. When you look at, certainly when you talk to businesses, and you can see this empirically, the biggest thing that drives investment is the opportunity. If there is a business opportunity, there is an opportunity for future profit. That's what drives investment. And in an economy that is growing, in an economy that where businesses are hitting capacity constraints, that is the major thing that is going to drive investment. With respect to our own monetary policy, certainly we will be looking at investment, we will be looking at productivity, but we will be looking at everything else as well. Ultimately, our interest rate path will be driven by what it takes to bring inflation back to target. Productivity and investment is one and an important input to that outlook, but it's not the only input.
Michelle, did you have a follow-up?
Thank you. I do, yes. And then do you have any comments on the economic impact of the blockades of the Ambassador Bridge?
Well, I guess the first thing I'd say, somebody who lives in Ottawa in particular, certainly the blockade is very distressing for residents of downtown Ottawa, and many of our own Bank of Canada employees live in downtown Ottawa, and I've certainly heard from them. They are being affected. With respect to our own operations, our head office is in downtown Ottawa on Wellington Street across from Parliament, and the blockade is certainly making access to the building difficult. Most of our employees are already working at home due to the pandemic. Given the difficulties in accessing the building, we have restricted the building to only the most essential workers. We have a second site in Ottawa. We have a major operation in Calgary. We have offices across the country: Halifax, Montreal, Toronto, Vancouver. So we are operating as normal out of those offices. So at least for us, while the blockade is inconvenient, we're fully operational. For the economy more broadly, really the issue is if there were to be prolonged blockages at key entry points into Canada, that could start to have a measurable impact on economic activity in Canada. We are seeing blockages at the Ambassador Bridge in Windsor, Coutts in Alberta. So far, they haven't lasted very long, but if they were to last longer, that would become a concern, a bigger concern. Look, most truckers are trying to get goods in and out of Canada. I do hope these blockages can end quickly. We've already got a strained global supply chain. We don't need this. I think Canadians are looking to buy goods. Canadian businesses are looking to export goods. And I think the sooner we can get this resolved, the better.
We'll go now to Greg Quinn of Market News, please.
Hello. In a very rough sense, you're moving towards tightening monetary policy. While you can see comments from the Prime Minister talking about having Canadians backs until the pandemic is over, suggesting more deficit stimulus. How do you ensure that the public doesn't see fiscal and monetary policy potentially pulling in different directions?
Well, I guess from our perspective, we have a clear mandate, Greg, and the need for emergency levels of policies, of monetary policies support have passed. Our economy has recovered from the pandemic. The pandemic, yes, the pandemic is still out there, and certainly certain sectors. We're well aware that if you're in international tourism or arts and recreation, it may not feel like the economy is fully recovered. But when you look at the economy overall, what we see is a labor market that has recovered. Employment is above pre-pandemic levels. People have come back into the labor force. Wages are rising. Companies are reporting high levels of labor shortages. Vacancies are very elevated. So, there is a broad range of indicators that suggest that slack has been absorbed. The need for emergency level monetary policy has passed. And so we have signaled very clearly to Canadians that interest rates will be on a rising path. That path, the steepness of that path, the slope of that path, how much we have to raise interest rates, those are decisions that will be taken at each decision point, and we will be certainly updating Canadians on our outlook for the Canadian economy as we go.
Thank you. Secondly, other central banks that have used major quantitative easing programs buying up government bonds, they often haven't returned their balance sheets back to where they were before they started the program. I mean, this is Canada's first time with full-on QE. Do you think we'll make more progress than other nations have done in dialing back the holdings of government bonds?
Well, it's hard to speak for other central banks, so let me talk about what we've done and what we've said. So, when we launched quantitative easing, we said we would continue until the recovery was well underway. As you're well aware, as the recovery progressed, we began tapering and we ended QE in October, entered the reinvestment phase. And in January, we indicated that when we increase the policy interest rate, we will be considering exiting the reinvestment phase and moving to what some people call quantitative tightening, which means allowing your balance sheet to run down. So we wouldn't be replacing the bonds that are maturing. We are not actively contemplating actually outright sales of government bonds, but once we lift off the policy rate, we will be considering exiting the reinvestment phase and allowing our balance sheet to shrink. With respect to the broader use of these extended monetary policy tools, the Bank of Canada came in very forcefully at the outset of this crisis. That was really important, and together with vaccines, with fiscal policy, it has worked. The Canadian economy has recovered. The other part of coming in force, though, was from the beginning being clear about the conditions for exit. And we have been clear from the start of the conditions of exit, and we have been exiting. And we've now removed all our emergency policies. An important element of sort of completing this first use of quantitative easing will be to when the time is right, let the balance sheet move down and get back to more normal levels. So yes, that is certainly something that is coming.
We will turn now to Julie Gordon of Reuters, please.
Hi, Governor. Thanks for taking our question. Given the lagged effect of monetary policy, any regrets on holding off from removing extraordinary forward guidance until you were certain that the output gap had closed, particularly as the supply pressures were already impacting inflation?
Look, we were very clear in our decision in January. We removed the last piece of our extraordinary emergency policy measures, and we signaled very clearly to Canadians that they should expect interest rates are on a rising path. Why do we do that? There's really two important reasons. First, slack we judge that slack now is absorbed. The inflation we're seeing now is not reflecting generalized excess demand in the economy, but slack is absorbed, and growth in spending has considerable momentum. So if so we need higher interest rates to dampen spending and bring it in line with supply growth. The other reason is that it's really important to keep longer run inflation expectations well anchored. Longer run inflation expectations, medium-term inflation expectations are well anchored. Not surprisingly, with the rise in inflation to close to 5%, near-term inflation expectations have risen, and our own forecast has inflation staying around 5% through the first half of this year, and that's frankly reflected in these short-term expectations. What we don't want to see, though, is that increase in short-run inflation expectations migrate into medium and longer-term inflation expectations. If inflation expectations become unmoored, it will become much more difficult to get inflation back to target. And those are the two key reasons that motivated us to be unusually clear that we effectively announced a major shift in monetary policy. And I think in the coming months, you will see that implemented.
Okay, thank you. And then just turning to the housing market, I mean, you expressed some concerns about Canadians overextending themselves. And, certainly in the last few weeks, in addition to an already hot market, we've seen a real frenzy taking place, and not just in the main cities, but also in the secondary cities. I mean, how crushing of a situation could this be for the Canadian economy?
Housing activity is certainly elevated. Housing prices have been rising quickly, and that is impacting CPI inflation through the shelter component in the CPI. With respect to activity in the housing market, look, we've had a vulnerability in our housing market for some time, and it certainly predates the pandemic. We've been highlighting the vulnerability, the combined vulnerability caused by high levels of household indebtedness and high housing prices for some time. The pandemic, the unique circumstances of the pandemic have exacerbated that. Because of public health restrictions, we've all been spending a lot more time at home. Naturally, people want more space. We've seen demand for single-family homes, particularly outside or in the suburbs of major urban areas. We've seen a real surge in demand, and construction has not been able to pivot and keep up with that, and that's been reflected in big increases in prices. As the pandemic recedes, hopefully we'll all be able to get out of our houses a bit more. We expect to see that pandemic-related demand start to come off. And also by signaling that interest rates will be on a rising path, that should have some dampening effect. So in our own forecast, we do expect housing activity will moderate. But having said that, we do expect it's going to remain at really quite an elevated level. Job growth is strong, wages have been going up, incomes are growing in Canada, immigration is rebounding, so there are certainly some elements of sustained demand in housing. And I think that really points to the importance of the supply side. And I am pleased to see both at the provincial level and at the federal level of governments more focus on the supply of housing. We've really been in this situation now of ebbing and flowing in the housing market, but sort of sustained strong demand for almost a decade. And I think that really does point to the need for more focus on supply, and I'm pleased to see that is underway.
Next, we've got Eric Hertzberg from Bloomberg, please.
Afternoon, Governor. What are the implications for the interest rate tightening path if businesses don't pick up spending and capacity doesn't accelerate at the pace you're expecting? How key is this investment recovery in the bank's near-term action?
Well, as economists like to say, everything else equal, If productivity growth is weaker, that means we're going to have less growth and potential output in the economy, less expansion of our supply capacity. And other things equal, that means that interest rates would have to go up more. So in taking the decision that we took to remove emergency policy measures and signal a rising path for interest rates, as I outlined, an important reason for that is we need to bring demand the output gap is closed, there is strong demand. We need to dampen demand for spending and bring demand in line with supply. You have to look at both the demand part of that and the supply part of that. So the more we can increase supply, the more the economy can grow without inflationary pressures. Our goal is very clearly to bring inflation back to target, and the interest rate path that we decide on as we move forward will reflect our outlook for inflation and how well it is in fact coming back to target.
Thanks. And following to that, can you give us an update on your thoughts regarding the neutral rate of interest? What's your estimate for the end point of the hiking cycle, and is that evolving?
So the neutral rate. So the neutral rate is it's something that we can't observe directly. I think it's certainly lower than it was in the first decade of inflation targeting, but exactly where it is a hard thing to be very precise about. When you do a forecast, you have to put an estimate in. We have a range of about, which is a range of 1 percentage point, which is centered on 2.25 or 2.25%. That sounds very precise. I want to dissuade you of the view that we can be that precise about it. But that's what it is. I mean, that's our estimate in our model, in our projection. I think what I would emphasize is one of the key features and one of the benefits of an inflation target is that as we raise the policy rate and bring inflation back to target, we're going to see how the economy evolves. We're going to see how the economy reacts to higher interest rates, and as we see that, we'll learn something about where that neutral rate is. It's even possible that we, for a time, have to raise interest rates above the neutral rate to get inflation back to target. On the other hand, if there's headwinds, new headwinds emerge in the Canadian economy, maybe we don't get all the way back to the neutral rate. Those are things we will see over time. I think what's clear right now is interest rates are at ultra low levels. The economy overall has recovered, and interest rates need to move up. How much they need to move up, how fast, and where they end up, those are decisions that we'll take through time as we learn how the economy is reacting to those interest rate increases.
Okay, moving quickly now, I've got two names left on the list. Ian Bickus of Canadian Press, please.
Thanks for squeezing me in here. Just quickly on the expectations for inflation and concerns about becoming unmoored. With so much coverage of it and wage rises and such, I guess just how concerned are you that it is becoming a midterm issue, or that people are seeing it as a longer term issue? How close are we to getting to that point?
It is a concern, and I think what Canadians are experiencing is we've seen some broadening of the inflationary pressures across a broader range of goods. So, it started in a fairly narrow set of internationally traded goods and energy. It is now spread to, it's worked through transportation costs. It's spread to a broader set of goods. It's also spread to food prices. Part of that are higher costs of transportation. Part of that is also there have been some in Canada. We've had floods, we've had droughts. Other parts of the world have also had some adverse weather conditions that has increased food prices. So there's no question that Canadians are seeing inflation on a broader set of goods, and that certainly can start to influence their psyche. That's why it's been very important for us to get out and signal very clearly that we are not comfortable with where inflation is. Inflation is too high, and we will be bringing it down. It is going to stay, unfortunately, uncomfortably high through the first half of this year. We expect probably close to 5%. In the second half of the year, though, we do expect it to come down relatively quickly to about 3% by the end of the year, as the pandemic eases, as these global supply issues that have been driving this big increase in the price of goods recede. You'll see it come down. And we've signaled that to get it the rest of the way back down to the target, we are going to need higher interest rates. And I think by signaling very clearly to Canadians our commitment, our intention, and our actions, I really hope that assures Canadians that they can be confident that inflation will come back to target.
Right. And then quickly, you talk about businesses need to invest more in hardware and such, but how much of an inflationary pressure will that have in the short term?
Well, you're right that increased investment demand creates demand in the economy. But the other thing that investment does is that if you give workers better tools, better equipment to work with, workers become more productive. What that means is that the economy can pay higher wages without causing inflation. It means there is more capacity to grow with the same number of workers, and that actually puts downward pressure on inflation. So while there can be a timing issue, the investment and productivity are actually essential to sustaining growth and bringing inflation down.
And finally, we'll go to Mark Rendell of The Globe, please.
Thanks so much for squeezing me in at the end. Hi, Governor. Was wondering, you seem quite optimistic about business investment, and I'm wondering how much investment in the energy sector plays into that, and whether you see the kind of rebounding price of oil being a big driver of business investment.
So with respect to oil and gas, we do expect, particularly with prices as high as they are, we are expecting some pickup in investment, but we're not expecting as much a pickup as we have seen in the past. And that really reflects, I think, the global transition to cleaner sources of fuel. And so the investment response we are expecting is more muted in oil and gas than what we've seen in the past for the kind of prices we're seeing today.
And just following up on that, how important is, I guess, being clear about what the transition to net zero by 2020 or 2050, the steps around carbon taxing, carbon border tariffs, how important is it to be very clear about those things, their sequencing, if you're going to convince companies to invest in potentially carbon-intensive industries?
Well, certainly, in Canada, I think the clarity around the carbon tax is very helpful. I think Canada globally is among the leaders in this, and I think more clarity around carbon taxes around the world would be helpful. I think economists certainly see this as the clarity around the price of carbon is helpful in spurring the rotation that we have to see around the world. With respect to the Bank of Canada, we have been doing a fair amount of work on this. Look, there is a lot of uncertainty. Clearly, we've never transitioned to zero carbon growth before. We've never addressed climate change before. But an important message is we can't be paralyzed by that uncertainty. And one way to try to address that is to use scenarios. So they're not predictions like our forecast, but they are plausible scenarios. And in January, we put out a range of plausible scenarios. And I'll just highlight two key messages that come out of that. First of all, while they're not projections, they're scenarios, what you see in all the scenarios is the Canadian economy needs to go through a considerable amount of adjustment. We do make, we have pretty conservative assumptions about technological change, and certainly more rapid technological change, more innovation in clean tech could help make that transition smoother. But certainly in all the transitions, there's a lot of adjustment that needs to take place, and that adjustment is on a scale that it has macro implications. And one of the things we're increasingly going to be working on is looking at what are the sort of macro implications, what do those mean for monetary policy. That's not something we're going to figure out between now and the next monetary policy decision, but it is something we're going to be working on over time. The other key message that comes through is that if we delay the adjustment, when the adjustment comes, it's more abrupt, it's more disruptive. There is a bigger risk of a rapid repricing of assets that could put stress in our financial system, which would make an already difficult adjustment potentially even more painful. So, the message is, the sooner we start and the more we can gain momentum, the higher the chance of a smooth adjustment path to zero carbon growth.
And that will conclude today's press conference. Thank you, Governor Macklem. Thanks to all the reporters for participating, and thanks to all of you for watching and listening. We'll see you next time.